Hi everyone. So we're back with another episode, catering to topics that CFOs are interested in. So today we have Ray joining us. I'm going to talk a little bit about preparing a SaaS company for IPO. So maybe to start with, we take introduce ourselves, Ray.
Yeah, great. Thanks, Saurabh. I appreciate your inviting me to your podcast. My name is Ray. I am based in the San Francisco Bay Area, in the financial district. And over the years, I have worked with a large number of large and small tech companies in the SaaS and adjacent spaces in a variety of verticals, including healthcare, AI/ML, fintech, process type companies like ERP, and reporting companies like business intelligence providers. I've also worked with companies that are earlier stage, kind of from their first investments, i.e. seed to Series A, B, C, D, where they're in hypergrowth mode, to companies that grow more inorganically via M&A and are backed by private equity funds, and then finally companies that go public and tap into public markets for equity as well as public debt. And a lot of this work has been in and around the SaaS space. And I'm very excited to share my thoughts with you, Saurabh, and kind of get your feedback as well and what you're seeing in the marketplace.
Oh, awesome. That's great to hear. There's a lot of experience. So I think, I think, I think you're probably the best person to answer. How is an IPO different from a private investment? Like, why would a company IPO when they could raise money privately? Given that, like, I've heard that, it takes a lot of work to actually IPO. Like, why even get into it?
Yeah, so here's the thing. I see companies at different points in their life cycle and their evolution. Every company eventually is trying to get to a set of standards, right? And there's really three standards a company thinks about, or should be thinking about, whether they're thinking about it or not. Three standards they're held to. Number one is the financial standard. Are they evolving from a financial perspective, right? Are they growing their revenue, their ARR? Is their gross margin increasing? Are they building scale? So all of those things, right? And if you build that, then eventually, you make an impact on the industry you're in or the sector you're in. The second piece that every company is looking at is liquidity. To fund that financial performance, you need to have the right levels of liquidity, right? So are you generating the cash, or are you utilizing your cash to generate future cash at some point? And then the third piece is corporate governance, right? So do you have that corporate governance in place, which means that when you come to me and claim that you are growing as a company from a financial perspective and you have this liquidity, it truly is so. It's not something just on paper, right? And do you have the mechanisms in place? So once you hit all those three standards, right, then you have made the cut to be offered a seat on the table. And that seat on the table is now you're ready to go public, right? We have confidence in you now to buy your stock, right? And the public will invest in you. So that to me is what an IPO really means. And every company is on that journey. Not every company will make that cut. Of those that do make that cut, not every company will have the courage to take on all the so-called headaches that go with going
Right.
public. But those that do will then go to the next level, right? And that could be whether they want to raise additional funding, they want to build enhanced credibility with their customers, their vendors, their employees, uh, and then have kind of this next level of funding available to them from an owner perspective and investor perspective. To all the SaaS owners and investors that work with you, it means that this is a time when you will also cash in on all the hard work you've done, right? So you've done two
Oh,
things. You've taken the company to the next level, and you've been rewarded for all the hard work that you did. So that's what an IPO means. You could rise up to some level and not be public and still get pieces of that. But I think the in this is we are a capitalist, right, system, and for us that is the reward in from that perspective, that we've taken the company to the next level. So that's why you would want to go public as opposed to remaining private.
got it. So from what I understand, I think one is, if you have like a good financial record, and then if you have uh, and if you're looking to cash out at some level and add credibility to your company, Like those seem to be like the major factors for going public. I'm curious why those things are not possible by staying private company. An owner could cash out, right? Like somebody could purchase secondary privately, like from the owner, from the employees.
Right.
Uh, like what difference does an IPO really make?
Right. So if you think about it, I work with a large number of privately backed companies, right? So right now in the San Francisco Bay Area, and some of this data is probably private, but what I hear is that funding is down dramatically this year, right? And the rounds that are taking place are down rounds, right? So there is cash pressure. So companies are having to, are having to generate profits, conserve cash, cut down on costs, and do a variety of all of those things, which ultimately is telling on the growth of those companies, right? Going public, in many ways, lets a company be in charge of their own destiny, right? They are no longer going to private investors. Now they're going to public markets, right? And the valuation that they get in the public markets is driven by, the quality of their performance, right? And they are operating at a higher level of trust in the marketplace. So as long as they're performing and they are fulfilling their obligations, i.e., they're giving out certain forecasts and they're hitting those forecasts and they're doing things the right way, and they're maintaining all the right ratios and metrics that show that they are best in class, right? The funding that's available to them is significant. And they also have a great shot at performing better than private companies because they have greater credibility in the marketplace. So, so that is not available today to privately owned companies. And privately owned companies, funding typically is for shorter time periods, right? And it is available to you based on how you demonstrate growth. And sometimes those growth levers are driven by investors and not so much by management. I think the second big difference is a lot of the growth in the privately funded companies is driven by the boards and the investors, whereas in the public companies, the company itself takes ownership of their destiny. Yes, the board is critical, right? They are the ones that are driving. But then you make everything public and you let people look at your financials and you look at your forward-looking plans. So I think that big shift takes place. And
Got
I
it.
think the landscape changes quite a bit.
Got it. I think that's a great segue into like our next topic. Like, what does it take for a company to go public? From what I've heard, it's like a lot of work to actually get the house sorted, house in order to go public. Maybe you can throw some light on that.
Right.
Given that you've been part of these
Yeah,
processes.
no, absolutely. But and so kind of to step back like for a quick second to what we just discussed, right? If you look at the stock market right now, S&P is like close to 5,000, right? But if you look at the private funding space, things are, funding is very difficult to come by, at least at the higher level valuations that we're used to. So that's the big shift that takes place. I'm just trying to, kind of finish the point. So what does it take to, what does it take to go public, right? Um, Great question. I think every SaaS founder that's starting off a company, whether it's initial inception to, being mid-stage, really is marching towards those three fundamental things we talked about, right? Quality financial performance, good levels of liquidity, and backed all by corporate governance, right? No matter where you are as a company, that's kind of where you're at, right? And to kind of get to where you're at to where you want to go public, there's a few things you have to think about, and those things don't really change, even from the beginning, right? You start off with a concept where you say, okay, do I have a product that has a market fit, right? And you conceptualize that product, you take it to potential customers and alliance partners, and then you get a validation done. Once you're comfortable with that, then you build a business plan, right? So I think the quality of that just keeps getting better and better and better. But the steps don't really change, right? So the next step after that is you assemble a team, you get funding, you go to the market, right? You figure out your pricing, and you start making, you start getting business in. Now, as you're doing that, you start hitting a certain set of metrics, right? Whether these are your SaaS metrics like ARR, gross margins, paybacks, cost of acquisition, et cetera. And you start comparing those metrics with what you're seeing in the marketplace, right? And as you start doing that, you start you start trying to improve that, and you start trying to operate at the next level. And once you're at a point where you're consistently operating at the next level, now you can go to public markets and say, listen, I'm as good as it gets, right? Or I'm at the top 10%. So that's in many ways what this process looks like as well. Except that there's a lot of regulation and a lot of lot of legal work, accounting work, and audit work that goes into that control piece of it to help you make the case. But really, this is the fundamental process. So it starts by building up to the right set of metrics, making sure your financials are tracking to your business plan. And if they're not, then you have to change course and make sure they track to the business plan, right? Now, this is at a, and this is at a high level. Now we can get into like kind of more of the details of what that real process looks like, as you go from being I guess a private company towards somebody who is in the middle of the S1 filing to who's actually now just about to get listed on the NASDAQ next week. There's that whole
Right.
sequence of events that takes place, which gets,
Right.
happens in within a period of a year. So in within that 1 year, you'll go from, you'll wet your feet, like you'll put your foot in the pond, and then you'll kind of start swimming, and then you'll be at the other end, right? You'll be ringing the bell on the NASDAQ. And then
Got it.
before you do that, the year up to that is when you start making sure you're at the right spot. You start assembling the right team, and then you have to get to the right set of metrics, the right valuation for your company, and you have to fit that into the right market situation. So kind of that, those three things have to align, right? When the stars align is when you that's when you step into and try to cross to the other end of the river.
Got it. So you're saying that it's like almost like a 2-year process, like 2-year journey to actually get listed, like 1 year of prep and then 1 year of like the actual process
Right.
of listing. And is this mostly in the quality of bookkeeping, or is it like legal processes, or is there some other paperwork? Like, and what are the differences between the two stages?
Right. So, so for the kind of, for the stars to align a little bit, right? So there's the actual work which you talked about, right? Which is the bookkeeping, the legal work, the investment banking work, the investor relations firm, and the transfer, and the stock register and all that. But then before you even think about getting there, right? A few things need to happen. There's the company has to be ready, right? And then the market has to be at the right spot, right?
So what does it mean by the company having to be ready? Is it from a quality of bookkeeping perspective, or is it from the metrics perspective? Like if you mentioned earlier, where you need to be in a certain growth range or like a certain profit margin range. Would have to.
Yeah. So it's both of those things. It's both of those things. So all the quality of I think about the quality of accounting and financial reporting to be table stakes, right? I expect that to be at that high quality at all times. So,
Mhm.
so even to like the SaaS founders that start the business, I encourage them
Yeah.
that you should set up your books the right way from get-go so that your reporting and quality of your accounting is right. It doesn't take a lot, and you can do it yourself. You don't need to spend money on that, but you need to be aware of the need to do that. You guys are smart enough. You could start a SaaS company, right? You can do this. It's not very complicated. All it requires
Yeah.
is a little bit of discipline. And so, but yes, when you're getting ready for an IPO, then it's a different ball game at that point. Um, the first piece is getting the right set of metrics and scale, right? So it's one thing saying that I'm a $2 million SaaS company with a growth rate of 200 or 300% versus saying I'm a $200 million ARR SaaS company with a growth rate of 50%, right? The valuations are going to be dramatically different, right? I mean, at 2 million, you may not even qualify for listing, but let's say you're a 10 million company with a 200% growth rate, at which point you will qualify, versus a $200 million company at a 50% growth rate. Your scale is dramatically different. And so, it's important, and your profitability is going to be different as well. So as your scale improves, your profitability goes up. So you want to be at that optimal level of scale, profitability, and growth rate. Um, and, and the reason you do that is because that's when you get the highest valuation, right? And you have a fiduciary duty to get that highest valuation for your shareholders. So, so that's what I mean by getting the company ready. So your company is, let's say you have built that scale that, now you're at, at that higher ARR, your growth rates are still pretty high, but not, astronomical because your base is now higher as well, and your gross margins are now very high because they reflect the economies of scale that you've generated, right? So that's called getting a company at the optimal spot. Now you also need to get the financial side of that, right? Your financial, your accounting needs to be, what I call impeccable, and people need to be able to go back prior periods and say, okay, everything sort of makes sense. I can see the numbers improving over time. I can see the revenue build up. I can see the cost shifting, and I can tie my cost of goods sold to the revenue numbers, right? My OpEx, I can see declining as a percentage of revenue. And so this to me is a business that's healthy and it is growing, right? And now you bring in an audit on top of it and you get those financials validated. They will dig into details, but then ultimately, now you have third party validation that these numbers are correct and the company indeed is growing. The next thing that now you look for is the market condition such that you can enter the market, right? And the way, and everyone looks at it differently. The way I've looked at it, and I've been pretty successful from that perspective. I look at prior periods from a valuation perspective, and I look at multiples of valuations to revenue and earnings for comparable companies. And when I see that those multiples are like at the highest quartile or decile, I think then markets are at the right spot. The problem is the two of these two may never align, right? Your company may be ready, but the market may not be ready. Or your company may not be ready and the market is ready now, right? And that's what happens in a lot of cases. So, just to step back, there are a lot of advantages of going public because it builds credibility, it lets you control your destiny and tap the markets, both from equity and debt. So what you do is you don't want to miss out on an opportunity of going public, right? If the costs are not prohibitive and if you can do a large enough offer, I recommend doing a small IPO and get into the market at that point, because then that lets you do a secondary offer at some point when the market conditions
So,
change, right? Or you can tap into public markets. Either way, your liquidity problems go down a little bit, and you can navigate towards growth and get the credibility of a public limited company. Yeah, I took a long, I took a sort of a big detour to answer that question. And, as you go down this path, right, in between come quality accounting and audit. So the public company audit is a different ballgame. It's not, it's quite, it's held to a different standard. And
so how is it different from like a public company, from a private company audit?
from private
Like
company
when
audit,
an
right? Right.
yeah,
It's called a
how are they
PCOAB
different?
audit. Mhm. Right.
Because in a private company audit, generally, you have an investor who's initiating the due diligence process. So they ask for documentation, and then the company provides the documentation that's asked for. But in a public company, I would imagine that this would be different. Like you would have to follow certain standards that are set by the government, and
Right.
you have to be proactive from your side, which is like a completely different equation.
Yeah, it's so right. So there's two pieces there. There's the regulatory filings, and then there's the audit itself, right? So you hire an audit firm to do your audit, right? Hiring an audit firm is like going to the is like going to a third party accounting firm and saying, you come, look at my financials, and tell me if they are consistent with US GAAP, right? So, and when you go public, then they have to be consistent with what's called the PCOAB. It's called the Public Company Audit Standards, and those standards are a little bit higher. And so the audit firm will come, they'll examine all your historical financials. You basically open out the books to them, and they will go and test whether or not the numbers that you are presenting on the books are actually right. So it's no longer just the due diligence being done by a third party, because there is no third party here, right? It's just SEC. SEC is the only one that's going to ask you questions, and they rely on the third party auditor to do that work for them. So this third
Got
party
it.
audit firm, and you could pick a like a big four, like a Deloitte, right, KPMG, etc. Um, and there's a large number of very high quality boutique firms as well. So depending on the depending on the type of business you're in and the location you're in, you could you have a choice. But this audit firm will come and do that work on behalf of the investors and SEC, if you will, right? And then they will go and file that audit report on the day that you file your S1. That day they will also file the audit report saying that the numbers that you're presenting for approval with SEC are consistent, and they are, they think that those numbers are correct. They're materially, there's no material inadequacy among those numbers. Then the next piece here is a law firm, right? So for a small company, well, even small companies will have in-house general counsel, but typically, you would rely on a law firm that specializes in filing with SEC and NASDAQ, and then they'll guide you through that process. A big piece of that S1 filing really is you describing your business and you describing the drivers of your business, right? So there's a portion of in that S1 called the MD&A, which is really saying, here's how I performed, here's why I performed that way, and you give all that in writing to the SEC, right? And that becomes public record, and that's what people are going to read, and then going to say, yes, we like it, we think this company is on the right path, and we're going to invest in it. The downside also is that you have to make many things public that you would not otherwise in a private company, due diligence,
Right.
right? So that is a very big shift. Now you're in the public arena and you're open to scrutiny, but then that also brings you credibility.
Yeah. Got it. Got it. Great. And beyond financials and the legal side of things, like, are there any other operational or organizational changes that SaaS companies should prepare for or anticipate before going forward?
Yeah, I mean, so that, I think that's a great question. So ultimately, what's reflected in the financials or the quality of the financials is just a reflection of how you're managing your business, right? So, let's say you're doing a great job of getting a lot of revenue and selling, but ultimately, how you're managing your business internally is going to drive, in many ways, your operational efficiencies, which will be reflected in your costs, in your OpEx. It'll be reflected in your balance sheet in terms of your account receivable. And that's where, a lot of the liquidity piece comes in. So how are you managing your cash? Are you bringing, what does your invoicing process look like? So it's almost like you have to look at the entire operations of the company and you have to make it best in class, right? Or you try to make it best in class. And I want to touch on a couple of pieces here. I think billing becomes really critical, especially for a SaaS business, right? So in a SaaS world, you have billing that needs to happen, sort of an ongoing basis, and it has to follow ASC 606. There's contracts involved, and it has to adhere to those contracts, right? So collections and billing customers on time becomes very critical to maintaining the cash cycle, right? If you get that wrong, then first of all, you'll have problems with the audit, but then also your company won't be optimal. The second piece is managing the cash itself, right? So now you have, you're billing and bringing the cash in. How are you managing it? Where are you deploying that cash? Are you getting the right levels of return? Whether this is, deploying it in like T-bills, which gives you a great deal of flexibility, or keeping in cash or fixed income, or using some treasury platform. There's a whole range of options that are available to you, and you should really think about what would that optimal deployment be, and that's where a lot of the younger startups that are emerging in this space, they're offering pretty innovative solutions, I think, that help make that operational side quite effective. I think from a billing perspective, right? From a cash management perspective, we have these new fintechs like Brex, for example, right? Brex is a great solution. Bill.com, right? Bill.com is a great solution for making sure you're paying your bills on time, right? Brex literally offers you 30 days of free credit. There's other companies that allow you to invest in T-bills. There's a company here called Gico that will allow you to invest in T-bills and then turn it into cash whenever you want. So you get that enhanced return of whatever 4 to 5% that the treasuries are giving you. And then you have fixed income options, right? You could move into like a fixed income account. So there's all of these things. And then internally, you have to set up quality controls. So that boils down to improving your operations, but putting the right checks and balances, right? So if you're a SaaS company, you need to have multiple layers of sign-offs on different processes, so that we know that the corporate governance is in place and everything is transparent. So your operations will now change in a fundamental way. And you know, like it or not, now you have no choice but to scale, right? Because now that you change your operations in a fundamental way, you need to have greater scale to be able to support the profitability of that more complex operation. I don't know if that makes sense.
Got it. No, no, that makes perfect sense. So it's interesting that you mentioned that tooling is, like having good quality tooling is like important for to make this, transition to an IPO smoother. Like, have you seen examples where people without the right tooling have actually struggled to get there on time, or like what are the problems you're seeing with people who don't have the right sort of tooling?
Yeah, so I have some really great examples I could give you of companies that were not able to get an audit done because they did not have the right processes in place. And there was one example comes to mind. I won't, name the name. This company had raised over $1 billion, and their valuation was about 8 billion, but they could not go public. They could not even do a SPAC. And the reason was that they could not get an IPO done. So they could not get an audit done. And the reason they could not get an audit done was because their systems were not transparent, right? So in other words, when the auditor said, okay, you're saying that your account receivable balance is so much, can you demonstrate to us what bills are outstanding? And they could not do that. The reason they couldn't do that was because they didn't have the systems in place. And by the time they got around to doing that, the marketplace had shifted in a fundamental way. Ultimately, ended up going bankrupt. There's many of these examples. So if you have the right systems in place, you will create efficient and transparent systems that are auditable. If somebody comes to you and if an auditor comes to you and say, "Can you show me your account receivable balance?" You can show them all that. You can show them what invoices are outstanding. Uh, if they come to you and say, show us what your AP balance is, you can do that effectively. If you have inventory, some SaaS companies also have inventory, for example, right? And inventory lying in different places. Then you can show them where that inventory is lying, what the value of that inventory is, if it has been valued at the right time, and what the current levels are. You cannot do that just by throwing people at it, right? If you have a large number of people running operations, in my experience, that typically means that there is something wrong, right? If you have better systems, it leads to leaner
That's a very
organizations, right? That are more efficient and there's more transparency.
Yeah, that's an interesting way to put it. Like if there are too many people, running ops, then there is something fundamentally wrong.
Right. Especially when it comes to like finance and accounting. If you have too many people touching numbers, then that means, something is not going to add up eventually. Chances are it might add up, but just having systems on it, I think makes it much easier and more transparent.
Do you have a rule of thumb for like what's a good number, percent, number of people, for what's good, what's bad, or is it just like a broad idea?
No, yeah, I mean, over the years, I have my own, yardsticks. I'm happy to share them. It won't make me popular with a lot of your audience. I think finance teams should typically stay within 3 to 4% of the headcount of the company. And what that means is,
Mm-hmm.
that the finance organization has to now heavily rely on systems, right? And almost
Mm-hmm.
like get financials that are good to go. So they need to set up the systems. And I've seen when that happens, the books get closed on time, numbers almost tie out perfectly, and all the systems sync up. So there's always one version of truth. And now you can set up your dashboards on top of it. You can see all the metrics, and things can flow real time. If you have people assembling all those things, then there's just different versions of truth, and then a lot of time gets spent in trying to reconcile those. That's just a problem you want to stay away from. I think in terms of overall OpEx, a rule of 20%, right? If your overall OpEx is more than 20% of your revenue, then you're probably not extracting the economies of scale that you should, right? And you still have ways to grow. When a company is in its infancy, you will probably have higher OpEx, right? Because you have to staff it with the right people. But over time, once your revenue builds up, you want to get to that 20%, and then you want to keep it below 20%. So I'd say kind of those two, big metrics is what I look at.
Got
And
it.
they also help you make the case when you're going public, right? Investors will look at the same thing.
Mhm. Yeah, makes sense. Makes sense. No, thanks for that insight. I think uh, I have like one or two last questions, and this is on, like, let's assume that all this IPO process went like really smoothly. What are the post IPO process look like? Like in some cases, maybe the 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 people who you mentioned earlier, that it's the owners and the investors who are driving things before an IPO, and then after the IPO, it's the people who are driving it. the team that's driving it. How does this transition happen? Like, have you
Yeah.
seen this work well? Have you seen problems with this? When people don't do this right?
Yeah, I mean, so there's many ways to fail, right? There's many ways. It's very easy to fail in this, right? So a lot of companies will go public. Going public is it's not like a destination and say, okay, now an IPO is not a destination, right? You've just taken your game to the next level. Now you have to
Yeah.
stay at that level, right? So when you go through the IPO process and you do the road shows with the investors, you're demonstrating to them that you are thinking about the business and and they are putting their trust in you to operate at the level. Once you are public, you're required to do that, right? So in a ways, about 3 months before or 6 months before the day you go public is when that process really begins, right? You will go through a large number of regulatory filings, and you will have several due diligences, and in that process, you will learn to work with the regulatory, um, um, with all the regulatory authorities and with all the people that you will touch in that process. So you'll go through audit, legal counsel, SEC, NASDAQ, maybe even the Secretary of State, because if you do a stock split and all that, you do a lot of those filings. And in addition to that, you will implement several policies internally, everything from, your whistleblower policy to insider trading policy. You will have blackout periods when you won't trade for a few days before and after earnings announcements and such. And you will go through an educational process for the company. During these whatever 3 to 6 months, that transformation will take place when you will cut the cord, from your VC investors, and you will sort of start operating as a company, right? And people will be
Interesting.
trained to do that. But that's not where the issue is. Once you are public, now you will have certain number of days to hit, right? To do your to do your filings. So a few things. Um, you have to do your quarterly filings within a few days of your quarter ending. You have to do your annual filings within a few days of the year ending, right? And what that means is you need to also get your audits done in that time, and your audit has to finish on that day, because if you fall behind on your annual filings, it doesn't send the right signal to the investors, right? So um, if you have some important people or some important events happen in your company, some key people leave the company, you have to do an SEC filing within 2 to 10 days. I mean, there's different levels. Whether you're doing an 8K, so you have to do those filings, and you have to be prepared to have that level of transparency. So a lot of companies have a difficult time during this period, especially during the first few, I want to say months of going public, is adhering to this, to the regulatory schedule. And then the investors, is the second piece. So as a SaaS founder, right, if you have VC funding, you have a board that you're answerable to, and you have investors that are where you're presenting your
Yeah.
financials and forecasts. Now you have a large number of investors who will take your forecasts and who will make investments on that, right? And the markets will reward you if you are successful, and they will punish you if you're unsuccessful. So managing those expectations is very important, and giving them realistic forecasts is critical. There's also a legal aspect to it. If you're making statements that, I guess, push the envelope too much, right? And people make investments on that, they may then want to come back and hold you legally accountable for that, right? Because this is now all public. So I think a
Got
fundamental
it.
shift takes place, and the level of responsibility goes up. And
Understood. Are
management, yeah.
forecasts, sorry, are forecasts like really important? Like, are they required, or is that just like an optional thing that you might want to do?
No, so at your earnings call, the investors will want to know, right? Where's the company headed, right? What
Hmm.
guidance are you giving? You can choose not to give guidance. You can say, I don't know, but then that also doesn't send a great signal. Then you're telling, see, you're not being judged at that next level. But people want to know, how to manage your business, right? And if you don't know how to manage your business, then shareholders have a right to ask you to leave, right? They can say, well, if you can't give us a forecast, you don't know where you're taking the business, why should I invest in you?
Mhm.
So they will punish you then, um, by either uh, by and that punishment might reflect on your stock price. Or if you're a superstar who's known to like exceed expectation, they may still stick with you. But then,
Right.
you will cause a great deal of turbulence in the marketplace. And markets, by
Yeah, I think.
definitions, don't like turbulence.
Yeah, I think it's been a while, but if I'm not wrong, like maybe Warren Buffett doesn't like giving forecasts, if I'm not
Right,
wrong.
right.
But yeah, he's Warren Buffett, so
Exactly, right.
it
Yeah.
doesn't matter.
Yeah, well, yeah, so there's some people who can come and talk about, market in general and the evolution and, and that's enough. But, for the, for a SaaS, now we think about from a SaaS company perspective, right? You are entering a hyper competitive environment. A lot of SaaS companies are out there who are either going public or will go public, and investors really want to know, where should we think about where should we think about your company in the future? And your equity research analysts also play a big role in that, right? So they will also put out
Mhm.
forecasts where they'll give an opinion on what the target valuation should be for your company. And that
Right.
is sort of the street signaling, hey, we expect this company to be performing at that level. And from a corporate perspective, right, the SaaS company now has to be ready to work with these equity research analysts and provide them with whatever information they need, right, that help tell the story.
Got it. Yeah, thanks a lot, for your time, Ray. I think it's been like a great conversation. I think we got a lot of like I personally got a lot of insights from conversation with you. The best thing I liked was that the larger the team size, the finance team size, like the poorer your shop is run,
Right.
which is I think it's it's sort of relevant to like our space as well. So
Right.
that's great. And then like all your insights on like the IPO process, super appreciated.
Yeah.
So thanks a lot.
No, you're welcome, and I appreciate your asking me the question and giving me a chance to provide you with my opinions. So thank you.
Awesome. Thanks a lot, Ray.